Most people think investing means picking stocks, buying index funds, and maybe dabbling in real estate. Then there are hedge funds. These are the firms managing billions of dollars for the ultra wealthy. And the strategies they use to grow that money are so bizarre, so ruthless, and sometimes so brilliant that most people don't even know they exist. We're not talking about buying Apple shares and hoping for the best. We're talking about betting on hurricanes, front running the news circle, and making money when companies fail. Today I'm breaking down 5 of the weirdest and most effective hedge fund strategies ever used. And by the end of this video, you'll understand why the rich keep getting richer in ways most people never see coming. Before we get into it, a hedge fund is essentially a private investment pool for wealthy investors and institutions. Unlike a regular mutual fund, hedge fund can do almost anything with that money. Long positions, short positions, derivatives, leverage, real assets, almost nothing's off the table. That freedom is exactly why their strategies get so creative and so strange. Here are 5 of the most unusual ones that they have actually worked. Strategy 1: Short selling. Making money when companies collapse. Most people invest hoping a stock goes up. Short sellers do the opposite. They borrow shares, sell them immediately at today's price, wait for the stock to fall, buy them back cheaper, and pocket the difference. Sounds simple. The execution is brutal. In 2008, hedge fund manager John Paulson made $15 billion personally by shortening the US housing market before it collapsed. He studied the mortgage data, saw what nobody else was willing to see, and bet the entire system would fail. He was right. While banks were collapsing and millions of people were losing their homes, Paulson's fund was printing money. The strategy isn't evil, it's just cold, and it exposes something most retail investors never consider. In every market crash, someone on the other side of the trade is winning. Strategy 2: Catastrophe bonds, literally investing in disasters. This one sounds like something from a movie. Insurance companies face enormous exposure when natural disasters hit. Hurricanes, earthquake, flood. To offset that risk, they issue what are called catastrophe bonds or cat bonds. Here's how it works. Hedge funds buy these bonds and collect high interest payments, often 8 to 15% annually. In return, if a major disaster hits and triggers the bond's conditions, the hedge fund loses its principal. The insurance company uses that money to pay claims. If no disaster happens, the hedge fund wins big. Hedge funds have made enormous return in air with no major catastrophes. They model hurricane paths, earthquake probabilities, and flood zones with the same precision a meteorologist would, except instead of forecasting the weather, they are pricing it. The uncomfortable reality? Their profit depends on disasters not happening, which means somewhere in a hedge fund office right now, someone is quietly hoping for a calm hurricane season. Strategy 3: High frequency trading. Winning by being faster than humanly possible. Some hedge funds don't trade on research analysis or insight, they trade on speed. High frequency trading firm place their computer servers physically as close as possible to stock exchange data centers, sometimes paying millions of dollars just to be 30 milliseconds faster than everyone else. At that speed, they can see a large buy order entering the market, purchase shares ahead of it, and sell them back at a slightly higher price, all before a human could blink. This is called front running, and it happens billions of times every single day. One firm, Renaissance Technologies, used algorithmic trading strategies so effective that their medallion fund averaged 66% annual returns over 30 years. 66% every year for 3 decades. By comparison, Warren Buffett, widely considered the greatest investor in history, has averaged around 20% annually. The uncomfortable truth about high-frequency trading is that every time an ordinary investor places a trade, there's a very good chance a machine somewhere just made a fraction of a cent off it. Strategy 4: Global macro. Betting on entire countries. While most investors on individual companies, global macro hedge fund zooms out, way out, and bet on the movement of entire economies, currencies, and governments. The most famous example is George Soros breaking the Bank of England in 1992. Soros identified that the British pound was overvalued and the UK government couldn't maintain its exchange rate commitments. He quietly built a $10 billion short position against the pound and then waited. When the British government was forced to devalue the currency and withdraw from the European exchange rate mechanism, Soros made over $1 billion in a single day. The British Treasury lost billions trying to defend that pound against his position. One man's analysis versus an entire government's financial resources. The analysis won. Global macro is a strategy that most clearly shows what hedge funds actually are at their core. Not just investment vehicles, but institutions powerful enough to move markets and challenge governments. Strategy 5: Merger arbitrage, making money on deals before they close. When one company announces it's acquiring another, the target company's stocks usually jump, but almost never all the way to the agreed acquisition price. There's always a small gap. Why? Because there's always a chance the deal falls through. Regulators could block it, finances could collapse, the buyer could walk away. Merger arbitrage funds buy the target company's stock at the current price and wait for the deal to close at the higher acquisition price. They collect the spread, the difference between the two prices, as their profit. Individually, these spreads are tiny, but when you run this strategy across dozens of deals simultaneously, with hundreds of millions of dollars deployed, the return stacks up. The risk: if a deal collapses, the stock price of the target company often crashes back to where it was before the announcement, and the fund takes a significant loss. Merger arb firms live and die by the quality of their legal and regulatory analysis. It's less about financial modeling and more about understanding whether governments will allow deals to happen. So what does any of this means for you? You're never going to run a catastrophe bond portfolio or front-run trades with a server next to the NYSE. That world operates at a scale most people will never touch. But understanding these strategies changes how you see markets. Every trade has a counterparty. Every crash has a winner. Every piece of financial news is being processed by hundreds of algorithms before you even read the headlines. The most valuable thing these strategies teach ordinary investors isn't tactics, it's the mindset. The best hedge funds don't follow the market, they study it, find the gaps everyone else is ignoring, and bet with conviction. You don't need $1 billion to think that way. Next week, I'm going after another financial concept that sounds complicated, but once you understand it, you'll never look at the market the same way again. Subscribe so you don't miss it. And if this one made you think, send it to someone who needs to see it. See you next week.